Your car insurance bill just went up again, and you didn't get in a single accident this year. You didn't get a ticket either. You didn't even drive that much more, and the renewal letter still landed with a number that made you do a double take. The explanation on the bill blamed one word: inflation. That's not really the reason, and the real numbers prove it. Insurers and news headlines love blaming general inflation for rising premiums, and to be fair, inflation is part of it. But look closely at the actual numbers, and something doesn't add up. Vehicle repair and replacement costs have climbed roughly 45% over the past 4 years. General inflation over that same stretch was about 15%. Car insurance isn't tracking the economy, it's rising nearly 3 times faster than the economy. The average full coverage policy in the country now costs around $2,539 a year, more than double what it was just a few years ago. 6 states saw premiums jump more than 50% in a single year. In Nevada and Louisiana, rates didn't just rise, they doubled. Where you live changes this dramatically. The average driver in Florida pays around $4,326 a year. The average driver in Ohio pays about $1,112 for similar coverage. Texas premiums jumped more than 25% in a single year. New Jersey climbed 20% in 2025 alone, and jumped from the 15th most expensive state in the country to the 6th, right as new minimum coverage laws pushed insurers to raise their floor even higher. Part of the real reason is sitting in your own driveway. Modern cars are covered in sensors and cameras for safety features, and replacing a windshield with a built-in camera now costs around $1,200 compared to roughly $300 for a plain one. Every fender bender got more expensive to fix the moment cars got smarter. That effect isn't even the same across every vehicle.
Depending on the make and model,
some cars saw their insurance rates drop by as much as 12% in a single year, while similar-looking cars from a different manufacturer saw rates climb almost 9%, purely based on how expensive that specific model is to repair or how often that model gets stolen. Then there's what other people are doing to your bill without you knowing. Over 1 million vehicles were stolen in a single recent year, the highest theft total since 2009, with certain popular models targeted so heavily that entire manufacturers had to redesign their anti-theft software. About 1 in 7 drivers on the road carries no insurance at all, which means honest policyholders quietly absorb the cost when an uninsured driver hits them through a coverage add-on most people don't even realize they're paying extra for. Add staged accidents and inflated damage claims on top of that, and fraud alone is estimated to add another $5 to $10 to every single policy every month, whether you've ever filed a claim or not. None of it shows up as a line item. It just gets folded quietly into next year's number. Here's where it stops being random and starts looking like a pattern. A DUI conviction raises a driver's premium by about 35%. That part makes sense. But minimum coverage policies, the cheapest plans that lower-income drivers rely on because it's all they can afford, rose by about 14% too, faster than premiums for solid, well-covered drivers. The people paying the least are being asked to absorb some of the fastest increases of anyone on the road. Teen drivers, already paying some of the highest rates on the road simply for being young and inexperienced, saw their premiums climb another 17% on top of that.
most drivers also don't realize
Their credit history quietly factors into their premium in most states, even if they've never missed a car payment in their life. 2 drivers with identical clean driving records can be quoted very different prices, purely because one of them has a lower credit score than the other. Increasingly, None of this gets decided by a person at all. Most quotes are generated by pricing algorithms that quietly weigh your credit, your zip code, your vehicle, regional theft data, and dozens of other factors within seconds, long before any human employee ever looks at your file. By the time a renewal letter reaches your mailbox, the actual decision was made days earlier by a system built to protect the insurer's margins first. Insurers also seem to understand something about human behavior that works in their favor. Nearly half of all policyholders shopped around for a better rate in the past year. Fewer than 1 in 8 actually switched providers.
Insurers know that raising your rate
Is far less risky than you'd think, because most people will grumble, compare a few quotes out of habit, and pay it anyway. Switching takes paperwork and a phone call. Staying takes nothing at all, and insurers price their renewals knowing exactly which option most people will pick. And here's the part almost nobody connects to their own bill. Insurers don't just make money from premiums. They invest the enormous pools of cash sitting between when you pay and when a claim actually gets paid out. When the stock market is doing well, insurers can afford to hold rates steady or even cut them. When the market dips, insurers lean harder on premium income to stay profitable. Industry analysts say this openly when they talk to each other, even if it rarely makes it into a renewal letter written for an ordinary policyholder.
A soft investment market
Is one of the clearest signals that premiums across an entire industry are about to climb, regardless of how carefully any individual driver behaved that year. So your renewal bill isn't only a reflection of how you drove this year, it can also be a reflection of how an insurance company's investment portfolio performed, something that has nothing to do with you at all. To be fair, insurers aren't inventing these cost pressures out of thin air, and it would be too simple to pretend they are. These are real businesses navigating real, well-documented cost increases. Litigation costs, medical bills after serious accidents, and genuinely rising repair complexity are all real and documented. A single hospitalization after a crash can run past $50,000, and even defending against a frivolous lawsuit can cost an insurer $20,000 before it's thrown out. Insurance is a real business with real rising costs, and somebody has to pay for that math to work.
Some insurers now offer a way out through
Telematics, a small device or app that tracks your driving and can knock up to 30% off your premium. It works, but it also means the only way to guarantee a fair rate is to let your insurer monitor your every move behind the wheel, every hard brake, and every late-night drive, permanently, in exchange for a discount that other drivers get to keep without being watched at all. In one recent survey, nearly 3/4 of drivers who saw a rate increase blamed inflation as the main cause. Almost none of them mentioned repair costs outpacing inflation 3-1, stolen cars, uninsured drivers, or their insurer's stock portfolio. That's not an accident either. Inflation is simple, familiar, and doesn't invite any more questions. The real explanation is longer, more specific, and points in directions insurers would rather you not think too hard about.
So the next time your premium goes up,
And the reason listed is just rising costs, remember that's true, and also incomplete. The real incentive behind that number is bigger than your driving record, and most of it was decided somewhere you'll never see, by people weighing repair costs, theft data, lawsuit exposure, and their own stock portfolio long before your renewal letter was ever printed, and long before you ever picked up the phone to ask why. Subscribe to keep learning how the numbers on your own bills actually get decided behind the scenes.